On the panel today we have Skule Storheill, CEO Awilco LNG, Oystein Kalleklev, CEO Flex LNG, and we have Andy Orekar from CEO GasLog Partners, and we have Antoine Lafargue from CFO Tellurian. It's been 5 years. It's been 5 years since rates last time were above $100,000 a day, and rates have been below cash break-even for more than 4 years. Rates are up 5-6 times in the course of 6 months, and we argue LNG is clearly the hottest shipping segment these days. So looking forward to a good discussion. They actually, yeah, okay. Okay. They have not put the most updated slide pack on the stage, but that's...
rates are higher now.
Huh?
Rates are higher.
Rates are high. Okay, so we skipped that. Rates have now surpassed $100,000 a day, and high season has just started. October is usually, in terms of seasonality, on par with the yearly average, if you at least look at past 7 years seasonality, and now we're at 6-digit rates, and the high season has just started, as I mentioned. We're going to discuss demand drivers, supply of ships, etc., but how can a picture turn so rapidly from rates at 20,000 in the second quarter and now way above 100 in Q4? We're going to have an open discussion.
No, I think it's basically fundamentals. You know, you had this slump which has lasted for 4 or 5 years, driven primarily of 2 factors. One is the delay of all the Australian trains; they are all coming on stream now. And then you had, of course, a lot of optimism after Fukushima. Maybe not in Japan, but for ship owners. And of course, they order a lot of vessels. These vessels hit the market. Then you had delays, but now, you know, people have been losing money for a long time, and you know this has affected the amount of new buildings. And suddenly, you know, when you have 10% growth every year in the LNG space, you know, back in 2000 you had 100 million tons, then you doubled it to 2010 to 200 million tons. 2020 you double again to 400 million tons. You probably be at 600 million tons by 2030. So you have this huge trend growth, which is helping the shipping segment, because when you have this trend line growth, you don't really have to go through a big scrapping cycle to rebalance the market. You only have to wait for the trend growth to catch up. And when you also then in addition have the fact that people haven't been ordering a lot of vessels lately, then, you know, surprise, surprise, the market will be tight and people will be making money again.
I think that sums it up very nicely. I think what's important to note is this year we have had a summer market in the LNG side, which is basically the first time in 5 years that we've seen a spike in the rates in some time. And of course, it's not unusual or unnatural. It's just a factor that shipping is getting tight, and when there's there's always been more activity for the summer because you use LNG gas to produce energy or electricity, and of course electricity consumption goes up during the summer. But over the last 4 years, there's been too many ships around, so we haven't actually seen a spike in rates, whereas we have seen a spike in activity. This year, shipping market was a bit more tight, and of course we saw a spike in rates. Now, everyone expected it to come down again over the summer, which it didn't really do. It was a bit more quiet after the summer, but, well, as you say, we're back into 6 digits, looking quite interesting towards the winter. And this is in a year of 2018 where we have all-time high deliveries. So it's quite remarkable. Next year, deliveries are coming off big time, and yeah, I guess both Oystein and myself are looking forward to the next few years.
Not everybody expected the market to slip after the summer, because I was in a panel with you in March, and Nicolay Dyvik was asking me the same question. So how do you think the market will develop in 2018? I said it will cool down after the winter season. It will start picking up for the summer, and this year it's just going to keep climbing, because people will see that the market will will be very tight for 2018-19. So they want to, you know, get access to tonnage, and that's what happened. You know, you didn't have a shoulder month. It's just kept on going because everybody's seeing that, you know, suddenly you have had the luxury of tapping into the spot market for easy access to cheap vessels for a long time, and now you are getting afraid of actually getting a vessel to lift your cargo.
Maybe I'll add a point to this, which is it's interesting to see how on the LNG side the market was expected to be tight. Was not expected to be tight. It was expected to have 30 million tons of additional capacity for this year, and we were wondering how is this volume going to be absorbed by the market. And guess what? It's a commodity business. So supply and demand find a way to find an equilibrium. And actually all this supply has been absorbed by the market yet again. And we expect that it's going to continue next year as well. And then we have high prices. So in the end, what we really have is a tight market for this year, and we've got another 30 million tons coming to the market for 2019, another 30 million tons coming for 2020, and then we expect that there's going to be a period of pretty high prices in the LNG industry in general.
We argue that U.S. exports is like the main catalyst of the reshaping of rates. There were 0 volumes out of the US in 2015, and this year we forecast in the mid-20s, and by 2021 about 70 million tons. And the distance the US exports are heading is about twice the average. Could one compare the LNG cycle? Finally, there's the slides I wanted to have. Here you see, on the chart to the left, you see US exports. This is our forecast. So by 2018, you have 22 million tons, and by 2021, you have about 70 million tons. And you see our forecast of average sailing distance to the right. If I ask you, Tellurian, first, how would this picture look from the US side in 2023 and 2025?
So look, I think it's a shipping conference, so obviously it matters to talk about the distances, but when we are on the liquefaction side of the equation here, we are talking to our customers, and the question to our customers is, what is the all-in price of the LNG, right? So you need to take into account a number of items that includes, okay, what's the cost of sourcing the gas? What's the cost of liquefying the gas? What technology do you use? Access to labor, all this, cost overruns. Cost of financing, having the depths of the US market to finance projects. And then eventually you have the shipping cost, right? So when we see new projects being developed, whether it's congratulations to Shell and the LNG Canada project in general. We talk about Arctic LNG too. How do you get around the Northern Sea route to go back to Asia? You also have to factor in all the rest. So I've mentioned the 4 key items, but maybe you think about taxes and potential subsidies. And when you factor all this in, the question from the customer itself is, what is the cost of my LNG delivered to Shanghai or Tokyo Bay or one of these places? So at the end of that analysis, we firmly believe that LNG coming out of the Gulf Coast is going to be very competitive on a global basis. And that's because, you know, at the end of the day, the LNG, the world in general on the energy side wants more LNG, and the US is incredibly well positioned to satisfy this need. There's a lot of gas coming out of shale. We've got incredible technology and ability to develop projects. We are at Tellurian, we're developing driftwood, and we're using a EPC contract with Bechtel. So we feel highly comfortable we can develop the project on time and on budget. And then when you look at the cost of sending the LNG to, say, Japan, with about 100,000 day rate, you had $2 an M back and forth, return included. And then sometime when the LNG rates are closer to $70,000 an M, we're closer to 150 to 175 or so. So all this taken into account, that makes the LNG coming out of the US very competitive on a global basis. And we think that you're going to get a lot of that shipping activity coming out of the US, yes. If one look in 2014-15,
then the LPG shipping companies managed to capture the arb between the US price and the Asian price. And if you compare now with the LNG, there's a $3 margin on the table, and rates are in excess of $100,000 a day. Who will capture that arb? Could rates double from here? We just started. We're probably a few months into a multi-year LNG cycle. So who will capture this margin?
I think the big difference between LPG transportation and LNG is, of course, that our clients control a much bigger share of the fleet on LNG. But of course, the few ships that are actually trading in the spot market should be able to capture as much, well, as there is when and if the market is tight enough. And I think it's just up to us ship owners to well, we can say act responsibly, but don't over-order. And let's just try to keep this this advantage we have for as long as possible. And of course, LNG ships takes 3 years to build, so we know what the supply is going to be over the next 3 years. What happens after that, of course, is another matter. But we see already now that our clients are looking for longer-term charters. They're looking for both prompt delivery, but also forward delivery, and I can't blame them.
Nicolay, I would just add there's been a generally supportive backdrop with the oil price and where JKM has been. Perhaps JKM feels like it should be a little higher now than it actually is at $85 Brent. But with that backdrop and the general opportunity for our customers to make money in that commodity price environment, clearly there is a lot of room for shipping rates to increase. But I think it'll generally mirror the appreciation we can see in the cargo market for further upside from some of the levels you just mentioned.
Oystein, would you like to add on this, or?
Of course, I think, when you go and meet charters today, they say, oh, $115,000 a day, it's quite expensive. So let's talk 1 year. So then I say, okay, you can get it for $114,000 then. So because market will be very tight, why would you want to give that away? We've been suffering the LNG ship owners for several years now. So then the next question is, okay, what about 3 years? But as Jons mentioned, there is 3-year lead time more or less on a ship. So why, the market's going to be tighter for a long time, so why do we want to give away a lot of discount on going 3 years? So then they ask, okay, what about 5 or 7 years? So that's the good thing when you have a good and tight shipping market, is you're adding period to the market. And that's also what's happening in the physical market. 2017, you had long-term fixtures, 3 to 5 years. They were up from 25 to 50. Year on date, they are up 60%. So once the market gets tight, the tables are turning, and people are also getting more concerned about getting access to cargo so that they can fulfill their lifting obligations. So I think rates have a way to go here. Absolutely.
But what do they respond when you say that? Would you like 1 year at 140?
No.
So we're not there yet.
We're not yet at 140, no, not yet. We'll see. Yeah. We'll see.
Okay, this is taken from our research. On the slide to the left, you see the average sailing distance in LNG shipping, and it peaked in 2012 with the Middle East exports, and then you had a lot of US and Australian liquefaction plants coming on stream, which led to a decline in the average sailing distance. And then with US volumes, you saw then sailing distances increase again. How should we think about, if you look on the chart to the right, you see that the distance of US volumes, these are actual 17, is twice Australia and 1.85 times the average of the market. How should we think about the distances of US volumes when you also move into tariffs? Just a brief slide on this. If you look in 2017, 11% of US LNG was exported to China, but it was only 3% of Chinese imports. On the chart at the bottom left, this has increased to 6% by H1 2018. So how should we think about the sailing distance going forward and the risk of tariffs?
the end market is Far East. So basically what's happening now is, China, they contracted altogether in total 1.2 million volumes from US, from Corpus Christi with Cheniere. And then, of course, they have 3 portfolio contracts with Total, BP, and Shell, where they can source this from wherever they want to, including US. But right now, they're just going to shift around on the cargo. So if they have a cargo from Australia to Japan, that cargo will hit China, and the American volume then will hit Japan. So you can easily swap around that on short-term basis, and could actually be good for ton mileage. But it's more a problem in relation to getting FIDs on new liquefaction plant in the US. And of course, the main beneficiaries of this policy is Russia, Qatar, Canada, where they can easily get better, offtake agreements. And, Qatar increased their capacity not from 77 to 100, which they plan to do, but 110. Novatek's Arctic LNG, that 20 million ton, that might very well hit the market now. So there is demand for gas, and it makes it a bit more difficult for Antoine, but he has a very good project. $3 FOB US, so it just illustrates how cheap gas is. Burn value of gas is 17% of Brent, that's $14, and if you can ship it for $3 FOB, it's much better to use natural gas than crude oil, and definitely coal, more from a pollution point of view.
Yeah, I feel compelled to respond. We actually feel comfortable with the situation, but that's probably because of our business model, which is a bit different than the usual way of developing liquefaction capacity. But I think you hit the nail on the head.
Of course, if you have a normal balance sheet, it's more like 550, but still it's very cheap with that kind of gas.
That is true. Look, the point that you made about the fact that we can swap cargoes around, that's very fundamental. That's also, look, the vice chairman of Tellurian is Martin Houston, who was one of the key people to push for destination flexibility. And I think that's what you see in the market today, but I guess the main point that I'm trying to make here is that this is now a global commodity, right? And then up until very recently, the past year or two, I would say that the LNG was still very much on a bilateral sort of approach between somebody who supplies it and someone who's the end consumer. Now you can swap the cargoes around, and if you look at 2017, 30% of the LNG business was traded on a spot basis, defined as less than 4 years. So when you have the spot business, then that means that from our standpoint, when we think about the tariff potential issues, then we're saying, look, we need to bifurcate this into 2 things. Do you need the Chinese investors to support and effectively underwrite your project financially speaking, or through contracts? And the second part is that going to have an impact on the overall LNG demand? So for us, we ran a process, went around the world and asked a number of potential customers/investors whether they wanted to invest in our project. We ran this process. We feel very comfortable and confident where we stand today. We expect a number of announcements soon, and be in a position to call FID in the first half of next year. So we do not depend on Chinese investors to come and invest in our project. However, I think it's fundamental to see that the growth in the LNG industry comes, a big part of it comes from China. So China grew 45% or so last year. It's on track to grow another 45% this year. It will therefore become the second largest consumer of gas in the market at somewhere between 55 and 60 million tons. And then so long as China continues to consume the product and wants to have more gas inside the energy mix, then this will translate in the strong demand, strong need for additional shipping, and strong need for new FID on liquefaction projects.
So tariffs is less of a worry then? To sum up.
I had lunch with Antoine and Mr. Fang from Bokom, and I told them, they should just send, Congress should give authority to Henry Kissinger to go to China. He could have Hank Paulson to have his briefcase and hammer out a deal, and then have a yes/no vote in Congress, and that would solve itself.
Okay. If we could have the slides back up again. This shows our forecast of ton-mile to the left, 18% in 19 and 12% in 2020, so that's 30% in 2 years. And on the chart to the right, we have supply growth, which will be 50% lower in 19 over 18. And if you sum the 19 and 20 supply growth, it will be 15% or half demand. So when you look at the rates today...
So you're actually saying that volumes are going up, ton miles is going up, and ships deliveries are going down?
Yes.
Okay.
Yes.
Was it too complicated, the way I said it?
You know, this is why he didn't order any vessels. He never got the math.
So in brief, ton mile, 2 years, 30%, supply of ships, 15. GasLog during the last peak, you kept on chartering out ships on historical averages, which saved you during the downturn. But you seek to benefit a bit more from the upturn this time when you look at this picture, if we're right?
Sure. Well, we do have two public companies, one a parent C Corp that is more exposed to the spot market that's very exciting as you're describing, and then our MLP, which has 13 ships, 12 of which are on term charters. And so I think we'll continue to have that greater desire for term business at the MLP and provide that visibility of cash flow for a more dividend-oriented story, and then certainly be patient and share each of my three fellow panelists' views on how strong the market should be over the next few years. So I think I think our parent company will stay more exposed to the spot market, and the MLP will continue with a largely contracted strategy.
And Oystein, you have 8 ships, and your main shareholder has an additional 5, and you're pretty exposed to spot.
Yeah, we have 13 vessels as well, but we haven't fixed any of them because we think the market will be great. So, you know, why to medium-term rates when you can do high rates? So that's basically our play. And of course, there's another big factor here, and that's the fact that there's been a huge technological shift on the vessels themselves. You know, 10 years ago, you still were running on steamships. So then 10 years ago, motor ships came along, and you cut your consumption 50 tons. You increased the parcel size by maybe 20%. And then 2 years ago, you had the first real kind of LNG vessels, slow-speed two-stroke engine, dual-fuel engine, where you can run on gas and liquid fuel. Parcel size is 30% bigger than a steam vessel, and the fuel consumption is 50% less. So those are the vessels for the future. And you know, LNG has been this kind of lagger in terms of technology. You know, nobody else was running on steamship. They went away from that technology a long time ago. And now actually you are on the leader in terms of technology, because you are running on slow-speed two-stroke engines, which are very efficient, and then they are dual fuel, so they can run on LNG. So this kind of scrubber issues, it's not an issue for us because we're running on LNG. And if you have a big container vessel today or a tanker vessel, you are looking into getting the same kind of engines as we have on our vessels. And 10 years ago, this industry was running on steam. So, and half of the fleet, more or less, are still steam. So it's going to be a big, you know, big issue for the people with the steam vessels to recontract those vessels, because people will be looking for the more efficient vessels with the bigger parcel size and less fuel consumption. And those are the vessels we have. We only have those kind of vessels. All our vessels built 2018 and then deliveries 1920s. And we have positioned ourselves for a better rate environment.
But to challenge a bit, this chart shows that by 2020, most ships' delivery will be mega ships, but in 2015, most ship deliveries were trial fuel. So what's the, and you know, and if you go another 8 years back, most were steam. So what's the risk of a new technology on ships that makes your
It's never been lower. It's never been lower because now you are the leader, you've been the lagger. So yeah, maybe you can do some better hydrodynamics, you can cut your fuel consumption like 2% on you know, structuring the vessel a bit different, but it's not like it's going to be a revolution because it's already happened.
So now it's done?
Of course, there's going to be gradual improvement, but not going to be this shift from steam to motor to slow-speed motor vessel with dual fuel.
Yeah.
I think it's important to point out that Oystein ships are highly efficient for the long-haul trade, where you get paid for your low consumption on full speed. And you also, of course, have the benefit of size, being a larger size vessel than ours at least. But if you go down to a regular trade, which unfortunately never actually happens in 19.5 knots, where you have the benefit, or maybe I should say fortunately for our sake, the benefit isn't really that big. It's still there, and of course size is still an issue for those trades that require the bigger ships. I think, and as you mentioned before, the older, I mean, there's actually a large part of the LNG fleet which is what I like to call commercially challenged, and it's not just from a point of view of a steamship which is less efficient, but it's also size. And size is not just a matter of earnings. It's in LNG. Size is actually a matter of fitting into the systems where you have. I mean, in the old days, the ships were standardized at 125,000 cubic meters up until early 2000s. Those ships are still running around, some of them, and but today there are very, very few trades where they can actually fit. And even now, if you look at the 138s, I think that's probably the smallest ship you can actually trade today, and you have to give a big discount. So there's a bunch of ships. There's actually almost 20% of the existing fleet, which is small and inefficient. That will definitely struggle, but of course might be saved by the market going forward over the next few years.
By 2020, we calculate that about 10% of steamships will come off long-term contracts. So what would happen to these ships? I assume the debt levels have been paid down, so their cash break-evens are relatively low.
Charters don't really care about debt levels.
Yeah, no.
They care if it fits into the logistic network.
Yeah. And I think for the reasons we've discussed earlier, our supply and demand view is that we need, you know, every ship we have in the market and then some by 2022. Our GasLog view is that we're at least 30 ships short in 2022, and so share Oystein's view that we've reached a maybe technological equilibrium on how much more efficient the ships can be. But for this very visible period when you know the supply perfectly of how many ships are going to be added to the market, we're going to need every one of those ships, and in our view, then some, which supports higher rates in every type of propulsion system that you look at.
30 ships by 2022. That's only 15 in 21 and 22. That's not much. This year we have 50 ships delivering, maybe a bit more than that as well. So.
Yeah, inclusive of that.
So Jon said, you know, all the first generation steam vessels, they are goners. You know, all the vessels left lower than 138,000 cubic, they are out of the business. And then the 138 to 155, they will still be around. Nobody will contract them for a long period of time. That's just using too much fuel. But you know, they can do short haul spot market, can probably do some term business, but not very long term business. And then the term business will be for the modern type.
So what's the premium rate you think you can achieve having a mega ship today?
You should ask the customer here, Don.
I'm building scale. Once I know exactly how many ships I need, I'll go and negotiate with our friends here.
Okay.
Sometimes you have a look and you see these graphs, and you know sometimes you assume that okay. Because basically the LNG is a live cargo. It's almost like having livestock on board. You have this methane slip. You have to burn that methane. You know, when people are putting this into the calculation model, they typically assume, you know, LNG costing $5, and then they're using this as the yardstick for calculating the fuel efficiency difference. Problem is you can sell that LNG at discharge port at $12. So once you have an efficient vessel, you have a more cargo to sell. If you have an inefficient vessel, there's less cargo to sell, and that price of that cargo today is $12, not $5, which a lot of people are putting into their models, which is the price at load port. But you know, when load port is $5-6 in the US and the price in the Far East is double, it's actually much more efficient.
Okay. If you look at the chart to the left here, this shows our forecast of additional liquefaction volumes coming to the market. So by 2019, we forecast an additional 45 million tons, and in 2020, 25 million tons. And we see in black how the US will increase its market share year by year. There's been delays to liquefaction plants historically. Now with a higher gas price, do we have the same risk of delays? How would Australia differ from the US in the years to come?
Look, I mean, the risk of delays is inherent to the way that you're building the liquefaction plants. I would say that I'm privileged to be part of the team at Tellurian with a number of people coming from Cheniere and the experience of building on time, on budget. But it's really a teamwork between our approach of building liquefaction and working with Bechtel as an EPC contractor. So I think that can be done on the Gulf Coast. I think Sharif Suki, if he was here, would say that I'm not sure that you can reproduce that all around the world. Some projects have been incredibly effective, like Novatek in Arctic LNG and Yamal, or at least Yamal. So it's possible. I would say that we tend to agree with your numbers. We have about 100 million tons over the next 3 years. So maybe scheduling is a bit different, but that relates to the some time delays on building those liquefaction plants. I think at the end of the day, at the end of that period, the question is, what else is coming online? That's really what's should drive a number of the consideration for people in the audience today, which is, okay, you've got these plants that have been sanctioned, that are being built, but which one are the other projects that are going to get built and require chartering of a significant number of ships? Driftwood, our project, is it's 27.6 million tons, so I would guesstimate that it's somewhere around 45 ships or so to manage all that volume by 2025. But you still have a situation where you have a number of projects being built. Then there's some kind of there's been a lack of FID of new projects, and then the world is continuing to grow and absorbing these volumes. So we need more FID. There's going to be a lot more LNG being consumed, and frankly, that means that we will need a lot more ships being built to satisfy the needs of the customers. So I think it's a high growth area. There's a lots of demand that is coming from that sector. We haven't really touched on IMO 2020, but each time I look at forecast on our side of the industry and the supply side, barely, I would say, people include maybe 10 or 20 million tons of capacity for that. But the potential is much more significant, and talking to you, there seems to be a lot more reality and more needs behind that. So there's a discrepancy there and probably some trades around that.
How important is, from a shipping perspective, to have the second wave of US liquefaction to be able in 2019 and 2020 to fix for long duration? Or is that just added surplus and positive, but not necessary?
I think we're more concerned about the second wave. Where it's coming from is not that important. So you see,
right here,
Canada, or if it's coming from Mozambique or Tanzania or Russia.
Yeah, I would say we share Antoine's view that U.S. LNG is going to be competitive all over the world, and we'd love to see more U.S. LNG built, but would agree it's where liquefaction around the world, and even LNG Canada should have longer voyage distances than the average today, regardless if it's the northern or southern route that the ships end up taking. So more liquefaction is for us necessary and will be built, and hopefully on timelines like yours that are very well managed.
Okay, so how to sum up? Supply of ships will go down and demand will go up, and rates are already at approaching $150,000 a day. So thanks for today, and I look forward to the next few years.
So do we.
Thank you.
Yes, thank you.